Okay, everybody, so let's talk about dollar cost averaging. And dollar cost averaging is investing a fixed amount of money over a fixed interval of time into an investment regardless of the price. So let's talk about this quick example very quickly here. In a month, let's say you have $4,000 in monthly income and you have $3,000 in monthly expenses. You take the 4,000 minus the 3,000, that will give you $1,000 in free cash flow. Now, let's think about ourselves as an institution. Why would I like to do that? Because on the Trade for Yourself podcast, we teach you how to trade and invest in the stock market for yourself so you can pick good stocks, okay? Now, good companies like to invest their free cash flow in a myriad of different ways. Now, remember, what is free cash flow? Free cash flow is the money that we have left over after all expenses, and we can decide how to invest the free cash flow whatever way we would like. Companies may decide to put a portion of their free cash flow onto their balance sheet and keep it in cash to make sure that everything is good. Companies may decide to put free cash flow to pay off debt payments, right? To pay a portion of their debt payments. Companies may decide to say, hey, we're going to take a portion of the free cash flow and we're going to buy back stock. We're going to purchase stocks and add value to shareholders. We may decide to pay a small dividend and decide to increase that dividend over time. There are so many things that a company may decide to do from a free cash flow standpoint. They may decide to reinvest back into the business. That way the company can grow over the long term. So many things that you can do with free cash flow. Think about banks, for example. Banks lend money and they provide credit to individuals that have a good debt to income ratio. When you have a good debt to income ratio, what is that literally saying? That means that you have a very, very solid amount of monthly income with low amounts of debt obligations, which means that you essentially have good free cash flow because the bank is saying, hey, this individual has a good debt to income ratio. So they actually have the money coming in every single month to actually oblige to the debt payment that is required. So think about yourself and think about, okay, when I think about my monthly income and I think about my monthly expenses, I have free cash flow and I need to be able to utilize that free cash flow to grow myself, right? To grow my investment account, to grow my bank account, to grow my potential investments. That's how you have to think about that free cash flow. So I say all that to say a dollar cost averaging investor would state something like, I'm going to take $500 of my monthly free cash flow and invest into SPY every single month. So when does dollar cost averaging work? I think dollar cost averaging works if you have a long-term time horizon, 3 to 5 years. We don't have to wait 20 years to make money. Okay, I want you to put that way, way, way into the back of your mind. Okay, long-term time horizon, 3 to 5 years. Remember, you are a long-term investor. We don't have to wait 20 years, but we have to wait a period of time to allow the compounding to work for us. Okay, we don't have to be in a rush, but we have to have a long-term time horizon. I don't want to make an investment into a stock or into a particular investment and ask myself, where is the money in 3 months? Okay, dollar cost averaging is not going to work in that particular scenario. Okay, when else does it work? It works when you use it to invest in ETFs and index funds. Remember, these investment products hold baskets of companies. So this type of investing mitigates your single stock risk, okay? This allows you to invest a portion of it every single month. Let's just talk about index funds for an example. Index funds are designed to match the returns of the particular index. The S&P 500 has an index fund. The NASDAQ has an index fund. The Dow Jones has an index fund. The Russell 2000 has an index fund. Those particular index funds that track those particular indices are designed to match the performance of those indices. And so put that into perspective. The reason why this works is because I'm having a long-term time horizon and I'm investing into a basket of companies. I'm not investing into one specific company, okay? That mitigates your single stock risk. So for beginners, I think you should utilize dollar cost averaging for ETFs and for index funds. Whenever you have been in the stock market for a longer period of time and you understand risk mitigation and things of that nature, maybe you can utilize dollar cost averaging for particular stocks if you understand how to value a company and if you are able to take on that risk. But that is only when you have been in the market for a long period of time. Now, dollar cost averaging also works if you do it consistently every single month. Dollar cost averaging is not going to work if you decide to do it on March 3rd and then you don't pick it back up until August 29th. It's not going to work, y'all. It's not gonna work if I decide to start on April 5th, but then come back and I don't start back again until May of 2024. It's not going to work. You have to do it consistently every single month and do a particular amount that you can actually commit to, right? If you can't do $500 a month, don't put yourself into that particular situation, okay? All these people on social media are going to tell you, hey, you got to have $1,000, $2,000, $3,000. No, you can start investing with as little as $50 or $100. You just have to make sure that you are doing it consistently. And you have to figure out a way to continue to grow your skill set so you can have the capital to invest more money, right? But dollar cost averaging works if you do it consistently. And it works when you invest a lump sum of money.